Welcome to the world of personal finance, where one move by the U. Central Bank, the Fed, can directly affect your wallet. Today we are talking about the federal funds rate. This rate is set by the U. Central Bank and is the interest rate at which banks borrow and lend to one another overnight. And although this rate has no direct influence on the rates consumers pay, it does affect the borrowing and saving rates we all see every day. Let's break down how the recent hike in the federal funds rate will affect your wallet. First, let's address credit cards. Most, if not all, credit cards have a variable rate, which means as the federal funds rate rises, so does the prime rate, which ultimately means your credit card rate also increases along with it. Currently, credit card interest rates are at a record high of around 20% on average. With higher prices already putting many people in a difficult financial situation, more and more people are carrying debt from month to month. People are racking up debt and borrowing at high rates, and this rate increase will cause consumers with credit card debt to spend an additional $1.7 billion in interest, according to recent analysis. When it comes to home loans, 15 and 30-year mortgage rates are fixed and tied to the economy. And so when the federal funds rate increases, so too do rates. The average rate for a 30-year fixed mortgage is currently at 6.48%, slightly lower than it was a few months ago, and exponentially higher than it was a year ago. This goes to show the power interest rate hikes have had on the market. Auto loan rates are also fixed, however, due to the raised interest rate and the high price of cars, payments end up higher than before. Right now, the average rate for a 5-year new car loan is 6.58%. This number may very well go up due to the interest rate hikes. As far as student loans are concerned, federal loan rates are fixed, so they are not directly affected by the federal funds rate hikes. The interest rate on federal student loans taken out for the 2022-23 academic year already rose to 4.99%. And any loans disbursed after July 1st will likely be even higher. Private student loans, however, are typically tied to LIBOR, prime, or Treasury bill rates, and so when these rates increase, so too do the interest rates on private student loans. Finally, let's discuss savings accounts and CDs. While the federal funds rate has no direct influence to deposit rates, they do tend to be highly correlated and do respond to changes in the target rate. Savings account rates at the largest retail banks are currently up to 0.39%, and top-yielding online savings accounts are as high as 4.5% according to Bankrate. One-year CDs have a rate closer to 5%, according to deposit accounts. With all this in mind, it's important to take measures now to secure your finances. Paying off debt, transferring to a 0% balance credit card, and boosting your savings are all viable options to consider in order to make sure you finish the year in the black. Well, that's it for today's video. Do your research and make sure you find the best rate for your needs. Until next time, stay informed.